The fate of most people's retirement rests in the hands of this chart, the stock market, in this single line continuing to go up. And at a distance, it looks very promising. This line has consistently gone up over the last century, averaging a 10% return. But the question is this line as certain as it looks? Can this line really fund our retirement? Well, most people would say yes, this line always goes up. But that's because most investors today have only lived in an era where that line has gone up. Since 2011, the stock market has been on its longest bull run in history, and before that, the second longest in the 80s and 90s. But the market hasn't always been this way. There have been long periods of stagnation where the market went absolutely nowhere, like here in the 70s, when the market failed to produce a return for 17 years, or right after the Great Depression when recovery took 25 years, or more recently when two back-to-back recessions left the market flat for a decade. People love to say that the market only goes up, but when you look a bit closer, that is not entirely true. I analyzed 100 years of the market, and what I discovered is that the market runs in two very distinct cycles. Growth cycles, where optimism makes it go up, and stagnation cycles, where it remains flat. And since 1896, there have been 9 clear cycles of boom and bust. And in this video, I want to explain those 9 cycles, from 1896 and the creation of the Dow to 2025 where the market stands at record highs, to uncover the full story of the stock market. And I hope that this video challenges how you view the stock market. Now, before we start talking about these 9 cycles, we need to go back to when the stock market became a single data point that could be measured. Chapter 1, Measuring Prosperity. Right now, if you want to see how the market is doing as a whole, there are many indexes that you can look at, like the Dow, the S&P 500, and the NASDAQ. However, back in the 1800s, none of that existed. There was no single data point that could let us know how the market is doing overall. However, by the late 1800s, 2 journalists named Charles Dow and Edward Jones asked themselves, what if the health of the market could be measured by a single data point? You see, these 2 journalists noticed that the growth of America's overall economy wasn't driven by the small companies, but it was driven by the large industrial giants, like steel, oil, gas, and railroads. And so they decided if you could track the stock prices of these large companies, you could capture the pulse of the entire American economy. And so they chose 12 of the largest and most influential companies at the time, added up their share prices, divided it by 12, and the result was 40.94. This number was the start of the Dow Jones Industrial Average. It was the first market index, and what this average did was turn the stock market into a single visual story. If the line goes up, the market is doing good. If it goes down, the market is doing bad. And it allowed people to see patterns like growth, collapse, and recovery in a way that almost felt scientific. And throughout the next 125 years, this line would move up and down in cycles, telling a story of how the market is doing. And so now, let's talk about these cycles. Chapter 2, America's First Bull Run. Now, when explaining these cycles, we're going to look at the Dow Jones Industrial Average, as it is where we can get the longest record of stock market performance, from 1896 to 2025. Our first cycle is America's first ever bull run that occurred from 1896 to 1906 in a return of 148%. Now, before the market began its first climb, it had just come out of one of the darkest moments in American history, the Panic of 1893, where railroad companies collapsed, hundreds of banks closed, unemployment reached 20%, and the U.S. gold reserves almost depleted. It was a chaotic time where many people lost their confidence in the future of the country. However, that confidence was restored when President William McKinley won on a campaign centered around the gold standard, and industrial companies began to consolidate and grow. And the Dow started to rise. From 1896 to 1901, the Dow rose by 91% in just 5 years, showing the market's strength. However, by 1901, the market would face its first test, and people would realize that the market doesn't just move because of the health of companies, but it can move simply by a few powerful, wealthy men manipulating it. By 1901, two of America's richest men, James J. Hill and E.H. Harrisman, went to war over a railroad, wanting control over the Northern Pacific railroads. It was their missing link to their railroad empires, and so both men started buying up shares of the Northern Pacific Railway in secret. Neither knew that the other group was trying to gain control. And as both sides kept buying, the stock price exploded from $150 to $1,000, and this caused short sellers to panic and sell other stocks like steel, railroads, and utilities. And from 1901 to 1903, the Dow fell 46%, and this was called the rich man's panic. This was the first event that showed people that the market could simply move by a handful of wealthy people manipulating it, but it wouldn't stay down for much longer. America entered the age of consolidation, where dozens of small businesses merged into massive industrial corporations, and by 1906, the Dow reached record highs, gaining 148% in a 10-year period. Although there was a hiccup along the way, it was America's first ever bull run, and it showed the resilience of the market. However, America would soon learn that every boom cycle eventually is followed by a bust. Chapter 3, when J.P. Morgan bailed out the American economy. By 1906, confidence in the market was restored. However, right after, it would enter its first cycle of stagnation. From 1906 to 1923, a 17-year period, the market went nowhere. It was the first lesson that every boom cycle is followed by a bust. In just a year after the market reached record highs in 1907, panic returned, and once again, it was because of financial speculation. A group of speculators tried to corner the market on copper stocks, but it failed, and then exposed a network of risky loans, making the Dow fall by 50%. And at the time, there was no Federal Reserve to come in and save the day. Instead, one rich man had to come step in, J.P. Morgan, who gathered the nation's top bankers and injected liquidity to stabilize the economy. Basically, one rich man saved the entire American economy, but this exposed one very deep problem in the US. The entire economy depended on the will of one private banker. And so the panic of 1907 set the stage for the creation of the Federal Reserve. In 1913, a central bank designed to act as the lender of last resort. For the first time, the government had the financial power to intervene for future panics, but stability wouldn't come easily. Just a few years later, World War I broke out, making America the world's industrial superpower. Yet once the war ended, the boom quickly faded into a post-war recession, pulling the Dow back down once again. And from 1906 to 1923, the market moved sideways, rising and falling, but ultimately going nowhere. And it showed investors a truth that would repeat itself throughout history. Progress in the market is never guaranteed. However, there was a pattern. Every bust was eventually followed by a boom. Chapter 4, the Roaring Twenties. So now we've reached the part of the story where more people might be familiar with. By the mid-20s, the American economy was thriving. From 1924 to 1929, the market went on its fastest bull run in history, producing returns of 294%. And what was behind all of this growth? Well, consumer culture had arrived with new technology. Electricity was becoming a standard in homes, and credit was becoming easier to get, which were all driving up industrial profits. But perhaps more importantly, this growth was triggered by a new group of investors, everyday Americans. Brokerage houses opened across the country, newspapers printed daily stock quotes, and radio stations discussed market trends. And with this new growth, they believe the market only goes up. And something that became very popular during this era was buying on margin, which is basically borrowing money to buy stocks. You could control $10,000 in shares with just $1,000 in cash. But if prices fell even just a little, you could quickly lose everything and then some. And by 1929, everybody was trading on margin, but one tiny slip-up could make the market come crashing down. Chapter 5, The Great Depression. Speculation is what drove up the market during the Roaring '20s, but that same speculation is what would bring it down a lot quicker. By the autumn of 1929, the market reached all-time highs. But because everyone was borrowing on margin, even just a small change could set off a chain reaction, and that chain reaction would happen for the next 2 years. The market would lose 90% of its value, bottoming out where it was 30 years ago in 1896. And that crash didn't just destroy wealth, but it destroyed faith. Banks failed, unemployment soared, an entire generation learned to fear the stock market. And then we'd enter our next cycle of stagnation. From 1929 to 1954, the market went sideways again, producing no returns. In those next 25 years, we're focused on restoring faith in the system. Under FDR's New Deal, a series of reforms were passed to bring trust back in the financial system. The Emergency Banking Act stabilized the system. The Glass-Steagall Act separated commercial and investment banking. The FDIC insured deposits, and the SEC regulated Wall Street. And after these reforms, slowly but surely, the market and the economy recovered. It often takes a crisis to make things get back on track. And World War II was that crisis. That created full employment, booming manufacturing, and America becoming the most powerful economy in the world. And once again, the bust was followed by a boom. Chapter 6, The Age of Confidence. After 25 years, a generation's worth of time, the market finally recovered, regaining its peak of 381 points in November of 1954. And then we enter this period of prosperity, gearing up for America's next great bull run. From 1954 to 1966, the market grew 154% in 11 years. The Great Depression was behind them, the war was over, and America was ready to spend again. The GI Bill creates a pathway to a strong middle class, and technologies fuel consumer spending. And from 1955 to 1959, the Dow doubled. And this is the period that many people consider the height of America's greatness. One job could last a lifetime, one income could support an entire family, and people believed the future would be brighter. And when it came to investing, this was a new generation, one that only heard stories of the crash of 1929. And with safeguards and new investments in place, a new generation of investors were born. And with this prosperity, the market reflected it. The Dow climbed, peaking at nearly 1,000 points, making people view the market as a responsible savings account. And by the 1960s, America had done the impossible. It rebuilt its wealth, its confidence, and its faith in the future. But at the point of this video, you should know that every boom cycle is always followed by a bust. Chapter 7, The Death of Equities. So now we've reached the part of the story where some people alive today still remember. If you were an early baby boomer, this is most likely the first market that you ever experienced, and it wasn't a good one. From 1966 to 1982, the market went up and down, producing no real returns after inflation. This marked the end of the post-war boom, and the economy started to worsen, and there were many factors that contributed to this. In 1966, the Dow dropped by about 20% due to cost of the Vietnam War. In 1969, it was down 15% because of high inflation, rising interest rates, and the war. In 1974, it was down 45% due to oil shocks, the biggest drop since the Great Depression, and in 77, down about 17% due to economic uncertainty. It went up and down for nearly 2 decades, not producing any returns. Investing was starting to look like it was dead. And by 1979, Businessweek published a cover story titled "The Death of Equities," declaring that inflation had killed the stock market. But as history shows us, the moment that people give up on the market is the exact moment it begins to turn around. And by 1982, it did, ushering in the longest bull run that America had ever seen. Chapter 8, The Era of Easy Money. After nearly 2 decades of stagnation, Paul Volcker's war on inflation restored confidence and stability. And the Dow began its longest bull run in history. From 1982 to 2000, the market increased by nearly 1,000%. And there were many factors contributing to this growth. Tax cuts and deregulations by Reagan unleashed corporate profits. And business in America was changing. Instead of chasing long-term growth, corporate America began measuring success by short-term stock prices. And this is also the decade where the stock market becomes many people's retirement plan. The 401k replaces the pension, and now everyone's life savings is poured in the stock market, and America's future is directly tied to this line going up. However, despite this bull run, there were some hiccups along the way. On October 19, 1987, the Dow plunged 22% in a single day, still the largest one-day percentage drop in history, and it took 2 years to recover. However, as we entered the 90s, that beautiful line kept going up, and the average American now had stake in the stock market, and it became America's national pastime. CNBC was created in 1989. Financial magazines became mainstream, and online trading platforms allowed people to trade stocks at home. And speculation once again reached all-time highs. The internet was starting to become the future of the economy. And companies with no profit, and sometimes even no product, saw their stock prices increase rapidly. In fact, the tech-heavy NASDAQ soared more than 500% in 5 years. People were getting rich, but as history shows us time and again, belief can only take the market so far, and by 2000, that belief was starting to be tested. Chapter 9, The Double Dip. By the turn of the millennium, for the first time in history, the Dow crossed 5 digits, a lifetime away from its humble beginnings at 40.94.
Market has closed.
Yes, 10,000.
And it is above 10,000.
We did it.
The market has closed. The Dow is above 10,000.
But a lot of this growth was built around speculation. Money poured into tech companies with no earnings, no products, and often no plan beyond a website and an idea. And eventually, the bubble burst. And from its peak in 2000, the Dow dropped by about 27%, while the tech-heavy NASDAQ dropped by about 80%. Proving once again that the market isn't built on logic, but on belief. And once that belief starts to fade, so does the wealth that created it. And very shortly after, the Federal Reserve stepped in to save the economy by slashing interest rates from 6.5 to 1%. And in the short term, it worked. But that cheap money also created a massive housing bubble. In 8 years after the dot-com crash, there was an even bigger crash. The 2008 financial crisis, where the Dow dropped by 54% in 2 years. And from 2000 to 2011, through back-to-back recessions, the market produced little return. And to try to fix the recession, the government stepped in with massive bailouts and stimulus packages to prevent total collapse. And the Federal Reserve cut interest rates to nearly zero and began injecting liquidity into the system. And these were the policies that would define our next era of the stock market, which brings me to our current cycle. Chapter 10, the longest bull run in history. So finally, our story leads us to today. Since recovering from the Great Recession, the Dow has increased by about 300% in the span of 14 years. But this growth was a little bit different. It wasn't necessarily driven by factories or innovation, but by near zero interest rates, corporate buybacks, and government stimulus. Every time the market stumbles, new money comes in to keep it afloat. Like in 2020, when the market dropped by about 36%, the Fed slashed interest rates to zero, and there was almost $5 trillion in stimulus. And within months, the market rebounded, while millions of Americans were out of work and businesses suffered. And today, the stock market stands at record highs. And for most Americans, it is much more than just a chart. It's their retirement, their savings, and their sense of security. But when so much of our future is dependent on one line going up, you can't help but to wonder, how far can faith take the market? And so I want to finish this video off with Chapter 11, Where Do We Go From Here? Alright, yet another deep dive story in the books. Let me tell you that doing this amount of research in a short amount of time as a one-man show ain't easy. A veces me duele la cabeza. But this video really challenged my own view of the stock market. The market might look like this simple line that always goes up, but in reality it doesn't. It moves in cycles of growth and stagnation. And so I want to finish this video off with 3 takeaways that I personally learned as the student from researching 100 years of the stock market. 1. The market always goes up, but humans don't invest for 100 years. People love to talk about how the market has gone up over the last 100 years, and that is a true statement. However, the truth is the average human being isn't going to be invested for a period of 100 years. Best case scenario, you will be invested from 30 to 40 years, and your results are going to be highly dependent on the cycles that you live through. 2. Investing is less risky than not investing. Although this video has shown us that investing is risky, I still believe it's a lot less risky than not investing. If you just save all your money, it will get eaten by inflation, but if you invest, you still have a chance for it to grow. And my final takeaway is invest in things that don't show up on a balance sheet. After looking at nearly a century of boom and bust cycles, it is very clear that the market really offers no certainty. You could spend your whole life doing everything right, and then the market can take it all away. That's why money should serve your life, not define it. You should use your money on things like experiences, relationships, and peace of mind, because those things will ultimately make you rich, not this line going up. Thank you so much for watching. If you enjoyed this video, please give it a like, subscribe for more like it, as only 20% of you guys are subscribed. I'd love to hear your thoughts in the comment section. And if you want to hear another very interesting story about why boomers are leaving America in search for a better life, give this video a watch next. And with that, muchas gracias, que tengan un buen día. Nos vemos, chicos.